today we're looking at accounting principles part 3. What I'm going to be doing is that I'm going to go for about maybe 1 hour 15 minutes on property, plants and equipment, which is a very important for every question that you get in financial accounting from now on, you will get a question on property, plants and equipment, on PPE. So it's very, very, very important. And then I'll spend the last 45 minutes on groups, on consolidation. So I mean, for those who are doing FAC2602, so I would just want to explain why we do what is called a pro forma journal entries. When we do that, what are we doing? What does it make sense? I mean, just for you to understand the principle behind consolidations and journal entry, just to make it very, very easy. All right. Okay, cool. So is there anyone, can you show by hand anyone who is doing FAC2602 right now in this call? Is there anyone? So today we're going to go to, like I said, property, plants and equipment, very important. It's going to be an interactive lecture. And at any point in time, please just ask any question, drop any note, whatever you do understand, just let me know. I am prepared to answer as many questions as possible. There's nothing like a stupid question. So please stop me, shout, raise your hand, whatever you do understand. I will repeat and repeat and repeat until you get it. Because remember, the fundamentals are very, very important. It builds, this knowledge builds on as you go along. Cool. All right. So accounting principle part 3. Today we're going to be learning about property, plants and equipment. It's the standard that governs it is called the IAS 16, International Accounting Standard 16. So this is the international accounting standard that governs the accounting for property, plants and equipment. Everything we need to know about property, plants and equipment as far as accounting is concerned. When we go to International Accounting Standard 16, it tells us everything. It tells us when to recognize property, plants and equipment, PPE. It tells us we can recognize PPE, property, plants and equipment, initial recognition. It tells us after we have initially recognized it, how do we measure it? We speak about measurement. We speak about after we've measured it, subsequently what happens to it. Yes, so the learning outcomes after today, I want you to be able to identify the scope and purpose of IAS 16, apply the definition and recognition criteria. I will explain why we do that. Initial recognition and subsequent measurement. We talk about the cost model and the revaluation model. We talk about depreciation. We talk about de-recognizing property, plants and equipment. And what do we mean by de-recognition and the journal entries as well. We'll talk about very, I wouldn't say complex, but in instances where there is an inspection of a PPE, how do we account for it, and so on and so forth. All right, good. So the first thing we will begin by is the recognition of a PPE. In accounting, before anything or any amount can be recognized in the financial statement, it first has to be recognized. It first has to be recognized. And that's why we call it recognition. So before anything can be put in the income statement or the balance sheet or the statement of change in equity or statement of cash flow, it has to be first to be what? To be recognized. And before you can recognize anything in accounting, right, it must first meet what? The definition of an asset. So it must meet the definition of the elements, the definition of an asset, or the definition of a liability, an income, expense, equity. So it must first meet the definition, which we discussed last week. Then after meeting the definition, it must also meet what is called the recognition criteria. So before you can recognize anything on the balance sheet or the income statement or the, what we call it now, the statement of financial position or the statement of profit and loss, you first needs to meet the definition of an asset, a liability, an expense, an equity, or an income. and it must also meet what? The recognition criteria before you can recognize anything. Before you can recognize anything. The last time we spoke about an asset. Who can remember the definition of an asset? So before I can recognize property, plants, and equipment, it must first meet the definition of an asset. Then after meeting the definition of an asset, then it must meet what is called the recognition criteria. We will discuss that one. Who remembers the definition of property of an asset? Just an asset. Can nobody remember definition of an asset? An asset is no one. Okay, so we said an asset is a resource controlled by an entity as a result of a past event, and then we said that what future economic benefits will flow. Or we said it's a resource controlled by an entity as a result of a past event. So that is an asset. So it's a resource controlled by an entity as a result of a past event. Yeah, the fact that it's a resource means that what future economic benefits will flow. So that for anything that I recognize on the balance on my financial statement, it must first meet this definition. If I want to recognize an asset, and if it's truly an asset, it must meet what? The definition. Good. Then after meeting the definition, then it must meet what? The recognition criteria. But each asset, each form of every asset has also got its own definition, right? So we know that property, plants, and equipment is an asset, right? And what is property, plants, and equipment? How is property, plants, and equipment different from an inventory? Who knows the answer? How is property, plants, and equipment different from an inventory? So we say property, plants, and equipment is a tangible asset. In other words, it must have a physical form. It's held for use in the production or supply of goods or services, or for rental to others, or for administrative purposes. And it is expected to be used during more than one period. That means it's expected to be used for more than 12 months. So that's the definition of what? Property, plants, and equipment. So this definition also encompasses it also takes into account the definition of an asset. So definition of a PPE is what? A tangible asset. It is held for use in the production or supply of goods and services, for rental to others, or for administrative purposes. And then it is expected to be used during more than one period. How is this how is property, plants, and equipment different from an inventory? Who knows the answer? How is PPE different from an inventory?
Property, plant, and equipment would be something I would use in order to advance the business. Inventory would be something I would use in order to produce products on a monthly basis to sell.
Okay, so basically what you are saying is that property, plants, and equipment will be something like an equipment, right? That I use to produce items. Yeah, equipment, furniture and fittings, computers. So all these items, I'm using them to produce something. In my business, I'm using them to produce something. But when it comes to inventory is something that I buy and sell. I buy and sell. And also inventory, I consume them within a period of 12 months. While property, plants, and equipment could stay on for more than 10 years, 12 years, depending. If it's land, it can stay there forever. If it's building, it could be there for about 50 years, 60 years, right? If it's computer, probably it could be there for about maybe 3 years, 5 years. Furniture, it could be there for about 20 years. So you can see that property, plants, and equipment are the items that they will be there for longer. And then I don't sell these things. I use them in the production of income. I use computer to produce, right? If I have a company and you come to my office, you see a computer. What do I use a computer for? A computer helps me to record transaction. It helps me to email. It helps me to do this. So all these things is part of what making the business. If I go to my printer or equipment or printers, I use the printer to print stuff, to email stuff, to email, to fax. You know, I'm using them in my business, right? If I talk about furniture, there are furniture that are sitting in my office. When people come there, I'm expected to welcome visitors or clients. Clients sit on them, and then we have business. So property, plants, and equipment are things or items that helps me in my business, for me to do, or for me to function as a business, right? Whilst inventory are things that what I sell. I sell them. So because of that inventory, I turn inventory over quickly. So within 12 months, I sell inventory to make profit. But I don't sell PPE. Do I sell PPE? Do I sell my computers? I don't sell them. Do I sell my furniture and fitting? I don't sell them. Do I sell my printers? I don't sell them. But I sell inventory to make money. So that is the difference between property, plants, and equipment and inventory. So whilst inventory, I'm selling them to make money. Property, plants, and equipment, I'm using them in my business. I'm using them in my business. Does everyone understand this? So that is the difference between an inventory and property, plants, and equipment. So if you look at the definition of property, plants, and equipment, it says what? It's a tangible asset. It's tangible. You can touch it. You can touch a computer. It's held for use in the production or supply of goods and services. Something that you hold in the production of goods. You know, computer, furniture, equipment, printers, or it says for rental to others. Maybe I have a building that I rent to people, right? That is also part of PP buildings. It's part of property, plants, and equipment, or for administrative purposes. What do they mean by administrative purpose? In my admin, like computers, like printers. And those things are used for what? For administrative purposes. So that is what a property, plants, and equipment is. Whilst inventory, I sell them to make money. Good. So, and the standard of IAS 16 tells us that before I can put anything or I can recognize an item of PPE, property, plants, and equipment, on my balance sheet, it must first meet the definition. So let's say it meets the definition. It is an asset. It's a resource controlled by the entity, and it resulted from a past event, right? So but it also says that for you to recognize it, it must be probable that economic benefits will flow into the company. As a result of me using the asset, economic benefits will flow into the company. That is one. When I use my computers to generate income, will economic benefit flow to my company? Yes, it will. It will flow. When I use my printers, will economic benefit flow to my company? It will. I'm using the printers to email, to fax. I'm doing business with it, and in turn, I'm able to communicate with clients. Clients will come and they will give me services, and then I will sell the services, and then I'll make money. So an asset, before you can call someone, it's something an asset that you are able to recognize in your balance sheet. It must first it's probable that future economic benefits will flow to the entity. And also, number two, it must have a cost that can be measured reliably. So if you have an item of property, plants, and equipment, and you don't have a cost to it, you don't have an amount, you cannot recognize it. So what amount are you going to recognize in your balance sheet? So if I have an asset, and I say an asset, and I don't know how much or the value of the asset, I cannot recognize it in my balance sheet. That is what it's saying. It's very simple. So before I can recognize something in the balance sheet, an asset, it must first meet the definition of an asset, and it must also meet what? The recognition criteria. Right? And what are the recognition criteria? That future economic benefits will flow to my company. And number two, there is a cost that can be measured reliably. So let's take an example. Furniture is bought for 50,000. Is this an asset? And if it's an asset, why is it an asset? Furniture is bought for 50,000. Is this furniture an asset? Does it meet the definition of an asset? So that's what the question is asking. Does it meet the definition of an asset?
No, it doesn't.
No, it doesn't.
Why? Give me the reason why.
The furniture won't be contributing to making the business go further.
Okay.
It's not going to produce income into the business.
Okay. Are you sure? So in your like so what item do you think is going to lead to an income in the business? What are you thinking about that is going to lead to an income in the business?
For me, it would probably be a machine that helps produce the items I'm going to sell, or the land in which I will build my firm where I'll produce the things going forward. Oh, okay, I don't have another example in my head right now.
No, it's fine. It's fine. Okay, good. So I understand your logic and I understand your point clearly. So you said you're looking at something like a machine that you are going to use to produce something. Then you can say that yes, I'm earning income from this.
Gordon?
Yes. Hello.
Gordon?
Yes, I can hear you.
There is also Victor on the chart.
Okay.
There's also Victor on the chart. He said furniture is an asset depending on what the company does to generate income. It could also be seen as a furniture for maybe the office.
Okay.
That's Victor.
Okay.
And then let me
All
also
right.
request Victor that when he should also maybe when try to raise his hand and when just will provide his answer.
Okay. All right. Cool. Thank you. Yeah, Victor. Thank you for that. Okay, so thank you so much for that. So I was still on the previous one to say that she was saying that furniture is not an asset because you are not. She's thinking that an asset will be something like a machine that you're going to use to actually, to generate income, to produce something. But remember, an asset, what is the definition? So every time that you are trying to debate whether something is an asset or not an asset, try to link it to the definition. Try and link it to the definition. Definition of an asset says it's a resource controlled by the entity. Is the furniture a resource? It is a resource. It's an item. And is it controlled by the entity? Yes, the entity has the furniture. It is controlled by them. They bought it. It's them. As a result of a past event, yes, the purchasing transaction. Is this something that is going to lead to, is it a resource? In other words, will it lead to economic benefits? Yes, it will. It will lead to economic benefit. Imagine you having a business, having a company, and there are no chairs. So when clients come to see you, what are they going to sit on? If a client comes and there's no furniture, they will leave. You have a business, you have a consulting firm, and there's no chairs, whatever. Which client would like to come and stand for 5 hours, for 10 hours to make a transaction? They won't. So that makes what? It makes furniture an asset. Because with furniture, people will come to the office, they will sit comfortably, you give them tea, you give them coffee, they will sign contracts, and you are making progress. I don't think there's a single business that you enter a premises that there's no chair. I mean, who would like to go to such a place? No. So furniture does meet the definition of an asset, and like Victor said, it does meet the definition of an asset. Whether you are selling, whether you are producing inventory to sell as an whether you are producing furniture to sell as an inventory or not, it is still an asset. So whether you are just using them in the office, or you are producing furniture to sell. Both are assets. Both are assets. Good. Does that make sense? Can I recognize this on the balance sheet? The next question. If it now that it meets the definition of an asset, can I recognize it on the balance sheet? Can I recognize this on the balance sheet? Okay, anyone else?
Gordon, Victor also wrote, yes, we can recognize it as we have recognized it as an asset.
Okay, all right. And I was saying that if we can recognize it, why are we able to recognize? Does it meet the recognition criteria? Does this furniture of 50,000 meet the recognition criteria? And what are the recognition criteria that we spoke about? Anybody to remind us of the recognition criteria that we discussed? We said that before we can recognize anything on the balance sheet or in the financial statement, it must first what? Meet the definition, right? And we are happy that the furniture is an asset. It meets the definition. Does it? Then we put it to another test. Does it meet the recognition criteria? And what are the recognition criteria? Does anyone remember? Okay, so we did say that recognition criteria is that what? It is probable that future economic benefit will come out of this. Will future economic benefit come out of this of the furniture? Yes. It will allow clients to come in and will make business and will get income. Does it have a cost which can be reliably measured? The answer is yes. What is the cost? 50,000. 50,000. So it meets what? The two recognition criteria. And remember, both recognition criteria must apply before you can be able to recognize it on the balance sheet. Both recognition criteria must apply. Then let's look at the second question. Rent. Rent is paid for 12,000 rand. Is this an asset? Rent is paid for 12,000 rand. Is this an asset? Remember, in accounting, you just need to argue. If you can argue your case, it is you are fine to go.
Tombo send is up. Over to you, Tombo.
Okay, Tombo.
No, it's not an asset.
Why?
And that's because it's not owned by the company as we're following the steps.
Yes.
It does help us to bring future income, but it's not an asset.
Okay, good, excellent. So it does. So Tombo is saying that it doesn't meet the definition of an asset. It's an asset, what? A resource controlled by the entity. It's not a resource controlled by an entity, right? I mean, rent. I mean, can I really be able to see rent and to say it is a resource that is controlled? No. It resulted from a past event, fine, yeah, because we contracted it before we got the rent, but it's not a resource that is controlled by the company. So that part, it falls away, and because of that, it cannot be an asset. And if it cannot be an asset, then it means that I cannot recognize it on the balance sheet, right? Because only assets and liabilities are recognized on the balance sheet. So therefore, where does this go? Where does this go? Or what is this? What element is it? What element is it? Remember, we spoke about the elements of the financial statements: assets, liabilities, income, expenses, equity. Which one is it?
I wanted to say expense.
Okay, all right. Why is that an expense? Do you remember the definition of an expense?
Something that takes away money from the business.
Yeah, it does take away the money from the business, and it also what? As a result of what? An increase in liability. It's an increase in liability or a decrease in assets. other than contributions from equity participants. Okay, good. Well done, guys. Well done. We are moving somewhere. Okay. Now we move on to a higher dimension. So thing that is an asset in the standard, it says what we if we bring it on the balance sheet, we call it capitalized. The term is capitalized. So whatever you put on the balance sheet or the statement of financial position is called capitalized. That the term we use is called capitalized. Okay. So to comply with environmental requirements, a manufacturer of chemical products has to install new chemical air filters to prevent the emission of toxic gases. The relevant values at year end, 30th of April 2010, were as follows. So we have, there's a company, the company has got equipment and other assets, and it is it's also saying that in order to comply with environmental requirement, the manufacturer has to install a new chemical filter. And the question is asking whether this chemical filter, should we capitalize it? In other words, should it be in the balance sheet? What do you think? Should this chemical filter be in the balance sheet? Just read the question. I mean, read the statement again. I mean, read the thing and just suggest your answer. They need to install the air filters to comply with environmental requirements. Does this need to be in the balance sheet? What do you think?
Victor say yes, as it is necessary to manufacture the product, so it will be part of the PPE.
Okay, good. Is there anyone who thinks otherwise? Do we all agree to what Victor is saying? Okay, good. Yes, so I agree with Victor. So he says that to comply with the environmental requirement. So if you don't comply with the environmental requirement, what is going to happen? They're probably going to stop your business. So that means this filter is necessary for you to earn income, right? So it is a resource, right? Is it controlled by the entity? Yes, it's going to be installed by the entity and it's going to be controlled by the entity. Did it result from a past event? Yes, because you're going to contract somewhere, they're going to construct it. And that whole agreement to construct this whole air filter is as a result of past event. Let's see if it meets the recognition. So it has first met the definition of an asset. Let's see if it meets the definition, the recognition criteria. Will it result in an inflow of economic benefits to the company? Yes, it will, because the fact that these air filters have been installed means that the company can continue with the business, right, to earn income. Does it have a cost? Yes, they tell us that the cost of the air filter is 800,000. 800,000. That means that what? It has first met the definition of an asset and also met the recognition criteria. So I can what? I can capitalize it as an asset. I can capitalize it as an asset. Good. Then here we say that then we talk about subsequent costs. So whenever you initially recognize the asset, according to IAS 16, you must first recognize an asset at cost. At cost. According to IAS 16, you must first recognize an asset at cost. Okay. Then we have subsequent costs. So after you have recognized your asset, sometimes your asset needs servicing. It needs servicing. So the normal day-to-day servicing or maintenance cost of a PPE item are not recognized in the carrying amount of the item, but in profit or loss and expense as incurred. Why is that? Why is maintenance and servicing not capitalized as an asset? but rather they are expense. Does it meet the definition of an asset? No, it doesn't. You know, when you have an item of PP and you are servicing it or you are maintaining it, it doesn't increase the maintenance or the servicing doesn't is not expected to result in an inflow of economic benefits per se, right? And besides, even the item, the repairs, it is a small item as well. It's not expected to improve the value of your original it's not expected to result in the improvement of your original assets. So that is why it's not capitalized, but instead it is what? It's expense. It expense. So every amount that you get needs to be analyzed on its own to find out whether does it meet the definition. If it meets the definition, does it meet the recognition criteria? Does it meet the recognition criteria? Okay, does this make sense? Any questions so far? Okay, so everything in property, plants, and equipment is easier unless then you come to what we call replacement at regular intervals. So it says that part of some PP items may require replacement at regular interval. For example, the relining of a furnace, the seats and gallery in an aircraft, the interior walls of a building, such as an office. So these items, oftentimes you replace them from time to time, right? And according to the standard in the standard of IS 16, this replacement cost should be capitalized. So if you have a major replacement of an asset, let's say you are a company, you own a plane, aircraft, right? And from time to time, the seats of the aircraft needs to be changed, right? According to the standard IS 16, the replacement, right? It's part of it has to be capitalized. In other words, it forms part of your property, plants, and equipment. And then you have to de-recognize, so you need to take out the old replacement asset. So remember, when you are replacing something, you bring in the new item, and then you must take out the old. So the standard is saying that when you replace a major component of an asset, that component has to be included as part of your property, plans, and equipment. And what was there before, the old item, needs to be taken out. It needs to be de-recognized. Does that make sense? Any question on that? So an entity recognizes in the carrying amount of a PP item the cost of replacing part of such an item when the cost is incurred if the recognition criteria are met. So if the recognition criteria are met, then you need to to capitalize the replacement of that asset. The remaining carrying amount of the replaced part is then de-recognized. Okay. And then this one also, inspection. So if you have a major inspection done on an asset, right? That major inspection has to be capitalized. It has to be included in your PP, your property, plants, and equipment. And the old and the amount you capitalize as inspection previously have to be taken out. It has to be taken out. We're going to read the question now, and then we're going to go through the question step by step. And this question is actually in your TAT letter as well, so it will help you to understand it when you're actually going over it. It says that certain assets need regular major inspection for faults, regardless of whether parts of the item are replaced, to ensure continuing operation. When each major inspection is performed, so whenever you make an inspection to a PPE, that major inspection needs to be capitalized. It needs to form part of your property plans and equipment. And the old inspection that you did last year or 2 years ago needs to be taken out. Does this make sense? Any questions? Any questions so far before we have an overview of the question in the third letter, which explains inspections? Because I selected this particular thing because oftentimes it confuses students a lot. So let's read the question. It says Deans Limited purchased a machine on the 1st of January 2012 for 1.6 million. The machine has to be inspected every 6,000 hours, which means that a major inspection will have to be carried out every 2 years. So according to their system or their company, every 6,000 hours is equivalent to 2 years, right? The last inspection performed on the machine was on 31st December 2011. That is just before the machine was actually purchased. And the inspection was done by the seller. And the inspection cost was included in the purchase price. The inspection cost was included in the purchase price. On acquisition date, the present value of the future expected inspection cost to be incurred was estimated to amount to 150,000. On acquisition date, an estimated useful life of 8 years was allocated to the machine. Do you understand the question? So at the date of 1 January 2012, a machine was purchased for 1.6 million. And a major inspection has to be done on this machine every 2 years. The last inspection was done by the seller and it was estimated as 150,000. And also we are told that the useful life of this machinery is 8 years. It's 8 years. So calculate the depreciation and the carrying amount of the machine for 2012 and 2013 if everything goes according to plan. How do we calculate depreciation? Depreciation is always what? The cost less residual value divided by the useful life. But in this case, because there is a major inspection taking place, we have to separate the major inspection from the asset. So if you look here, we can see that depreciation, the total cost was 1.6 million. There was an inspection done, and the total cost of the inspection was 150,000. So you do it this way. You separate the machine from the inspection component. So the machine, 1.6 million less than 150,000 is 1,450. And the inspection is 150,000. Because inspection is a different component of the asset, or it needs to be, or it's got a different useful life, we need to calculate the depreciation differently. Because remember, the machine itself has a total useful life of 8 years. Meanwhile, the inspection will last every 2 years, right? So we cannot calculate the depreciation by saying 1.6 million divided by 8. What about the 2 years? Remember, the inspection is included in the 1.6. So that's why we had to take out the inspection cost. So 1.6 million minus 150,000 to get 1,450 for the machine. Then inspection was 150,000. Then we applied the depreciation separately to the machine, and separately to the inspection component. So 1450 divided by 8, we get 181,250. That's for the machine. Then for the inspection, 150,000 divided by 2, because we were told that what the inspection is done every 2 years. Every 2 years. Right. We'll just do the first part of the question. The second part, you can just do it at home. The carrying amount on 31st December, how do we calculate carrying amount? Is the cost less depreciation or accumulated depreciation. So the cost for the machine was 1,450 minus 181,250 to get what? 1,268,750. And for the inspection, 150,000 less 75,000 to get a carrying amount of 75,000. So even though in the calculation you separate it into machine and inspection component, yeah, but when you are disclosing them in the financial statement, you must put them together. Because in the financial statement, we don't have, as part of property, plants and equipment, we don't have inspection. Inspection per se doesn't form part of your property, plants and equipment. So you do the calculation separately, but when you are disclosing in the balance sheet, you must combine them. So that's the depreciation for 2012. 2013 depreciation is the same. 1450 divided by 8, we get 181,250. Inspection components, 75,000. So by the end of 2013, the inspection component is fully depreciated. It's fully depreciated. Does this make sense? Are you confused?
My question is, why did we divide the 150,000 by 2? I understand why we divided the depreciation by the 8 years, which is the total lifespan. But why did we divide the 150,000?
Okay, thank you, Topo. This is a very, very good question. So we divided the 150,000. The 150,000 was divided by 2 because from the question it tells us that for the inspection, we inspect this machine every 2 years. We inspect this machine every 2 years. And here we've been able to separate out what the inspection cost is and what the machine cost is. So since we've been able to separate the machine cost from the inspection cost, now we need to apply different useful life to each of the machine and the inspection. So that is the reason why we had to divide the 150,000 divided by 2, and then if we remember, the 1450 is the main machine, which in the question they've told us that the main machine has got a useful life of 8 years. So that one, there's nothing can be done about it. It's a fact. The machine has to be depreciated or has a useful life of 8 years. But then what about the inspection cost, which has been included in the 1.6? We need to separate it out. And once we were able to separate out what the inspection cost is, we need to depreciate it over the useful life of the inspection. Remember, they told us in the question that inspection is done every 2 years. So that is the reason why. This is the only complex thing you will get in property, plants and equipment. That's why I brought it here, because it's quite it can be quite confusing. But the main idea is that if there's an inspection, you separate out the main asset from the inspection. The inspection will have a different useful life because they will tell you how long you do the inspection. So you divide it by the how long you do the inspection for. Whereas you are the entire total useful life to the main asset, which in this case is the machine. Does that make sense, Topo? Topo, are you clear, or must I repeat myself?
You're quite clear. I thought how I would have treated this, since we're looking at 2012 to 2013. I probably would have skipped it or would have just left the 150 since it was the inspection was done right before we bought the item. And then on the second year, since on the next statement, that's when I would have included the full amount of 150,000.
Oh, so you are saying that, but why would you leave out the 150,000? Because remember, the 150,000, according to the question, was the inspection that was done just before we bought it. So the question has already told us what the inspection cost is. So normally with PPE, the inspection that was done gives us an indication, or the inspection cost that was incurred gives us an indication of the sort of how much the inspection is going to cost in subsequent years, right? So just before we bought it, because this inspection was done on the 31st of December 2011, and we acquired this just a day after. We acquired this machine on the 1st of January 2012. So just before we bought this, an inspection was done. And they've already told us what the inspection cost is. So when I am calculating the depreciation for this particular asset, because it's a major inspection, I'm supposed to separate out the inspection cost from the main item and then apply different rates based on their useful lives. Because if you leave it out, then it's like you are not counting it properly. Because I don't know why you will leave it out in the first year and only bring it in the second year. Because before you bought this item, the inspection cost is already included, and they've told you it is 150,000. So when you are depreciated right from the Fed depreciation that you do, the inspection cost must also be depreciated. Does that make sense? Or you want to think about it a little bit?
No, I understand it now.
Okay, cool. All right. So just so from the understanding that you have, try and maybe at home try and do the part B. Okay. So now we have applied the definition of an asset. Now we have applied the recognition criteria of an asset, and we have now recognized this asset, right, in our balance sheet. So a PP item that qualifies for recognition as an asset shall be measured at its cost. And so it's telling us that. So now it's meet the definition of an asset, it's meet the recognition criteria, right? Now at what amount must we initially record it? So it is an asset, we agree. It has met the definition, the recognition criteria. So we know we are going to put it in our balance sheet, but at what cost? At what price? And that is when the standard IS 16 tells us that the cost of the PP item, it must be measured at cost. PPE must initially be measured at cost. There are other items of asset that different accounting standard tells us to measure it initially at fair value. For example, financial instruments like accounts receivable. The standard tells us that we must first measure it, we must initially measure it at fair value. But for property, plants, and equipment, the standard specifically tells us that we must measure it initially at cost. So after it has complied with the definition, and it has also complied with the recognition criteria, how do we measure it at? We want to measure it what? At cost. And what is the cost of an item of property, plants, and equipment? Is the purchase price, which includes the import duties and non-refundable taxes, any cost directly attributable to bringing the asset to the location and condition necessary for its operation, initial estimate of cost to dismantle it. So basically, it might be measured at cost. And what is the cost of an asset? The cost of an asset is the purchase price, that is the amount on the invoice, plus any import duties. Remember, in case you imported this asset from overseas, the import duties on this asset has to be included in it. Then any costs directly attributable to bringing the asset to the current location. For example, transport costs. So when it got to the harbor, you also transported it maybe using a truck from there to Durban. That transportation cost must also be included as part of your cost of PPE. Let's say there was some legal fees that were paid once the item was brought in. That legal fees must also be included as part of the cost of the PPE. Maybe before you actually got the machine to the ground, you had to to cement the floor. You had to lay the maybe put some bricks there and mount certain things before this machine can actually be used. So all those costs that you incurred to bring the asset to its current working condition must be included as its initial cost. Its initial cost. So in a question, they will give you all these items. They will tell you, yeah, the asset has an invoice value of 500,000, import duties of 20,000, non-refundable VATs of 20,000, transportation cost of 50,000. So all these things you must be able to know which one is included and which one is excluded before you can be able to determine what the cost of the item of PPE is. Then the last bullet says that the initial estimate of the cost of dismantling and removing the item to restore the site. So sometimes you get maybe a machine that you use, especially in the mines or maybe for some big projects. And the legal system or the contract, says that when you finish, you must actually remove the machine, clear the space, and restore the land back to its original form. And this is the cost, right? After you have maybe you've mounted the machine and you've operated it for 20 years. After the 20 years is over and you are removing this machinery, they expect you to do some work. You must clear the land, you must return the land back to its original form. So what accountants do is that they calculate the present value, right, of the money that you are going to pay in 20 years' time. And that present value of the money you are going to pay in 20 years' time, according to the IAS 16, it says you must capitalize it as part of the cost of the asset. So even though you are only going to incur the restoration of the site cost in 20 years' time, we calculate the present value. How much is let's say 20 years' time, we're going to pay 500,000. That 500,000 that we're going to pay in 20 years' time, how much is it now? Maybe it's about 250,000. We capitalize that cost of 250,000 as part of the cost of property, plants, and equipment. Does that make sense? So it will always be tested, I promise you. It will always be tested, this particular point. So don't forget it. The present value of the amount I'm going to incur to restore the land has to be included as part of the initial cost of the asset. Good. Any questions before we continue? We're almost done. Maybe in the next 5 minutes you'll be done. Any questions so far? I mean, we're almost done with FAC2601. Any questions? Okay. I have an example here, but I don't think we have enough time to actually to go through. But of course, the principle is there. So just go and try it at home. And when we meet and you don't understand anything, just let me know about it. Okay. Then after you have recognized an item of property, plants, and equipment, then you recognize it it met the definition, it met the recognition criteria, and we said we're going to put it on our balance sheet. Then we determine what the cost. So we also know the cost and we capitalize it on the balance sheet. Now that it's on the balance sheet, subsequently we need to measure it. That's what we call subsequent measurement. And what are the subsequent measurements for PPE? It's depreciation. Because after we've put the item in the balance sheet, we need to what? Subsequently measure it. We measure it by what? We depreciate the asset. And also we do what? We can also revalue the asset. So all this depreciation and revaluation is what? Is subsequent measurement. Another subsequent measurement that we do is called impairment. But for FAC2601, impairment is not going to be tested. It's a different standard altogether. It's called IS36. So IS36 deals with impairment of an asset, but it's not part of the syllabus in FAC2601. So the subsequent measurement is what? Depreciation and revaluation. Good. So let's do a little bit of an exercise. An asset with a cost of 100,000 and a residual value of 20,000 with a useful life of 4 years. Calculate the depreciation and pass the journal entry. The asset has a cost of 100,000, a residual value of 20,000, and a useful life of 4 years. Calculate the depreciation and pass the journal entry to account for depreciation. How are we going to tackle this? Anyone helping us? We are calculating the depreciation. This should be easy. Anyone to help us?
Kesana Road, 100,000 minus 20,000 divided by 4.
Good. Excellent.
That's all what is written.
Good. So the answer is 20,000, right? So because 100 minus 20 is 80,000. 80 divided by 4 is what? It's 20,000, right? So it's 20,000 is the depreciation. What is the journal entry? What is the journal entry to account for depreciation? Anybody? I have a depreciation of 20,000. 100 minus 20 divided by 4. What is the journal entry? What journal entry do I pass to account for depreciation? Okay, just give me the first part. What do I debit? I've calculated the depreciation of 20,000. What do I debit? What do I debit? What is depreciation? Is that an asset or expense or a liability? What is depreciation? Is it an expense, an income, an asset, a liability? Anybody to try?
I would say we would debit depreciation expense account and then credit the asset account. Or no, having it wrong. Debit the depreciation expense account.
Yes, debit depreciation expense account. What do you credit?
Gordon on the chart.
Okay.
Joyce said debit depreciation and credit accumulated depreciation.
Okay, that's right. That's right. Debit depreciation 20,000, credit accumulated depreciation 20,000. That is excellent. So that is it. Right. That is it. So whenever you debit depreciation expense, you credit accumulated depreciation. So the depreciation expense goes into the income statement or the statement of profit and loss, and the accumulated depreciation goes to the balance sheet or the statement of financial position. Okay, good. So that's some subsequent measurement, depreciation. What about the second one? A revalue. An asset of 150,000 rand is revalued to 200,000. What is the revaluation and pass the journal entry? So basically, let me explain what it is. So a revaluation is when you go and you revalue your asset. So let's say I have an investment property, and then at the end of the year, I want to go and see whether I want to know what is the value of my property. So I revalue it. And when I revalued it, in this case, I revalued it to 200,000. So initially it was 150,000, but when I revalued it, it is now 200,000. What is the journal entry for this revaluation? And where does it go? What is the journal entry? Yes.
Gordon,
Yeah.
Victor, on the chart, the revaluation is a surplus of 50,000.
Yes.
And again, he said 200,000 minus 150,000 equals to 50,000.
Okay. So what is my debit? What is my credit? What am I debiting? What am I crediting? What I understand that the calculation is 50,000. That is fine. But then what is the journal entry? What do I debit and what do I credit? And anybody have a revaluation increase of 50,000? What journal entry will I pass in my books to account for the 50,000? What is the debit? Remember, I've revalued from 150,000 to 200,000. That means what? My asset has increased in value by 50,000. If my asset has increased in value, what do I debit? Last week, we said an asset increases with a debit balance, right? And an asset has increased from 150 to 200, 150,000 to 200,000. What do I debit? You know this. Matoho, you know this. Help us, let's go. What do you think? Just try. Don't be shy. Just try. I've revalued the asset and I've got my asset has increased from 150,000 to 200,000. And I'm to pass a journal entry to account for the fact that my asset has increased. What is the journal entry?
Victor, debit relevant asset and credit revaluation surplus.
Yeah, that is right. That is right, because the asset has increased. An asset increasing with a debit balance. So I debit the assets and I credit the revaluation surplus. Remember, the revaluation surplus goes to what? Other comprehensive income. Don't forget that. The revaluation surplus goes to other comprehensive income. Good stuff. So that's it. Debit depreciation of 20,000, credit accumulated depreciation of 20,000, debit asset of 50,000, credit revaluation surplus of 50,000. So that is the solution for our question. Good. So I have another example, but there's not enough time. So I just want you to go and I've got I'll share the slides which will be uploaded. So you can actually go and do this question and then come back and come and ask. Just go and analyze it and do it. And then if you are finding any difficulty, just ask. All right, good. So today, what have we learned? So today we learned about, so we're not done. Okay, so this is the last one. We've talked about revaluation. Okay, good. So the last one is when an asset has now finished its useful life, or the asset has been disposed of, right? Or we are no longer going to receive any future economic benefits, then it means that the asset has no use for us, right? So when an asset is disposed of, when an asset is sold for my company, or there's no future economic benefit that is going to be derived from this asset, then I mean the asset must be de-recognized, which is the opposite of recognize. De-recognize it. Take it out of the financial statements. Take it out. Take it out. So what do you think will be the journal entry to take out an asset from the financial statements? What do you think will be the journal entry? I'm taking out the asset from the financial statements or from the balance sheet. What do you think? And anybody? Then we can close for FAC2602. Yes.
Victor on the chart.
Victor, yeah.
You would credit the asset.
You credit the asset. Good.
You credit the asset.
You credit the asset and you debit what?
And he continues by says, as you crediting the asset, you will decrease on the credit.
Yeah, so Victor, you credit the asset. That is fine, because why? Because now you no longer have the asset. So you do the opposite of when you were recognizing it. Remember, when you recognize the asset, you debited the asset, and then you credited bank, right? Because you bought an asset. Now that you are de-recognizing it, it's the opposite. You credit the asset and you debit, because once you dispose of something, you might get some money for it, right? So you credit the asset, you debit bank, and you might debit or credit profit on sale, depend on whether you got a profit from the sale or you got a loss from the sale. So that's how it works. But at least you were able to get one of the entry correct, to say you credit the asset, because the asset is no longer in your books, and then you debit a bank because you get money for it, right? And then after you've gotten the money for it, there's also a profit or loss on the disposal, right? Which you need to account for. Profit or loss on disposal. All right. Cool. Yeah. So so today we learned about property plans and equipment. We touched on the important aspect of the advance, but the other stuff you'll be able to go through the tutorial letters and get them. But I think this way, just for you to get the basics right, the principles right, and also just to touch on the complex ones. When there's an inspection, for example, when there's a replacement, for example, those ones are very complex. So that is what I touched on. But basically today, you've been able to get be able to know how to recognize an asset, right? To be able to have that, for me to recognize on the balance sheet, it needs to meet definition. It needs to meet what? The recognition criteria. Then I know I need to put it on my balance sheet. But at what cost, right? And the cost says that it must be at cost. And how do we calculate cost? The cost is plus import duties, plus dismantling, the present value of dismantling costs, plus any other cost to bring the asset to its current position. Then we spoke about subsequent measurements, right? We spoke about the fact that after I recognize the asset, I need to subsequently depreciate the asset. We learn how the depreciation formula, as is the cost less residual value divided by the useful life. And we also say that an asset might also be revalued. It might be revalued up or revalued down. And then we spoke about the logic behind the general entry. What does it mean? When an asset is revalued up, what is the general entry? When an asset is revalued down, what is the general entry? Right. This brings us, so I just want you to go and actually do more questions and practice. And sometime before we even start a new topic, and say, I've got a question here. Can you assist? Can you help? Then I am more than willing to assist. Good. Right. Now for those who are doing the FAC2602, one thing that I don't want you to have in accounting is just to cram things. In accounting, we don't cram things. Things must make sense. If I'm preparing a pro forma journal entry, what am I doing? What is the logic behind a pro forma journal entry? Why am I crediting investment and debiting share capital? What is the purpose of all these things, right? And that is what I just want to talk to you about, the principles. And once you get the principles, every other elimination journal entry will become very, very easy, because it's the same principle. Okay, so let's hit it. All right. So, on last week we spoke about the group, to say that we can have a simple group or a complex group. Actually, a group is where a holding company or a parent company acquires other subsidiaries, right? So we spoke about the simple group, and also complex group, whereby the other subsidiaries that the parent company has acquired can also acquire other subsidiaries as well. So it becomes a whole big group. And the standard of IFRS 3 tells us that because this holding company has acquired other companies and they have formed one entity, we need to prepare what is called a consolidated financial statement, or a combined financial statement, taking into account all the companies that we have acquired. all the companies that we have acquired. And we spoke about the principle to say it's very easy. All that I need to do is that I have the financial statement of the parent, I have the financial statement of the subsidiary. I join them together. When I join them together, then I make adjustment. I make adjustment. And I did ask that what sort of adjustment do we make? And he said, oh, we make adjustment on the on items that are common, or items that or any transaction that has happened between the parent company and the subsidiary. Remember, if I'm a parent company and I've acquired other companies, we form one entity. Now, if I sell to my subsidiary, I'm basically selling to myself, right? And you cannot sell to yourself. How can you sell to yourself? If you sell to yourself, you might not be able to tell us the true state of affairs of your company. Because imagine I am Standard Bank and I've gone to acquire Investec, for example. So now Investec is my buddy. We are friends. We are one entity. Don't you think that we can lie between ourselves to say, you know what? Why don't we lie to say that we actually made a transaction between ourselves worth $1 million? And meanwhile, we haven't done anything. We haven't done any such transactions, you know. So when we are accounting for, if we want to see the real economic transaction of the entity, any transaction between Standard Bank and Investec has to be cancelled. It has to be cancelled because we don't trust that. We don't trust that transaction. That transaction, you can actually lie to us. You can actually inflate the income. You can inflate the revenue. You can say, oh, yeah, Standard Bank and Investec, we did a transaction between us and the transaction is worth $1 million or $1 billion. Meanwhile, we are lying. Because we are one entity, we can collude and lie. So the authorities came together and said that no, when you are one entity, any transaction between yourself and your subsidiary has to be cancelled. It has to be eliminated. So that is why we make those adjustments. And that's why we make those adjustments. And that's why we prepare what is called what? The pro forma journal entries to cancel any transaction that has happened between the subsidiary and the holding company or vice versa. Right, good. So for example, if I am a parent, I'm going to narrate the story. If I am a parent company, right, and I have bought shares, right, in a company, I'm a parent company, and I've bought shares, right, in a company. What is the journal entry? What journal entry will I pass as a parent company? I've bought shares in Standard Bank, say 100 Rand. What journal entry will I pass? So in the parent's own financial statements, what journal entry would they pass? If I bought share, remember last week we spoke about share transaction. So that is because of this. That's why we did the share transaction. We also passed the journal entry to account for share transactions. If I acquire shares in another company, what journal entry do I pass? What do I debit? What do I credit? Remember, I'm the holding company, and I've bought shares in another company, or I'm a parent company and I've bought shares in another company. What do I debit? What do I credit? Give me the easier one first. What do I credit? I've bought something. What do I credit? Anybody? I bought shares. So what do I credit?
Bank would be the easiest.
Good, excellent. So so have a piece of paper in front of you and a pen, and write at the top, holding a parent company, write P. Write P. So have a paper, have a pen, and write at the top there, transaction in P. Transaction in P. So the P will say, I bought shares, so I'll credit bank. I bought shares, so I'll credit bank. So P will say credit bank. of 100,000. What do I debit? What do I debit? Remember, the share that I bought is an investment, right? So what do I debit? If I buy furniture and fittings, what is the journal entry? Credit bank, debit furniture and fittings. If I buy shares as an investment, what's my journal entry? I credit bank, what do I debit? I've bought an asset, haven't I? So what do I debit?
Gordon Victor said debit investment in company.
Yes, debit investment in company S. So debit investment in company S and credit bank. So debit investment company X 100,000, credit bank 100,000. Good, excellent. So that is the entry that the parent company will pass in their own individual books. Right? I'm a holding company. If I'm going to buy shares in a company, I'll say credit bank 100,000, for example, and debit investment in that company I'm buying into to say 100,000. Good. What entry will the subsidiary that is issuing the shares, what entry will they pass in their own books? So we've been able to get the general entry that the parent company will pass in their individual books. Debit investment in S, credit bank. What about S? What will S pass in their own individual books? What general entry? S being the subsidiary that issued the shares. What general entry will they pass? What general entry will the issuer of the shares, the one who sold the shares to me and I bought, what general entry will they pass in their own individual books? Remember, as a holding company, before I can buy those shares to say credit bank and debit investment, a company must have sold it to me for me to buy them, right? That company that sold it to me, what general entry would they pass in their books? Because they've issued shares to me. We did last week. If a company issues shares, what is the general entry? Yes, any takers?
Gordon Victor.
Yes.
Debit bank for subsidiary.
Debit bank for subsidiary, good. Excellent, 100,000, the same amount. And credit what?
And credit shares issued.
Yeah, or share capital, credit share capital. Credit share capital, excellent. That is it. Good. That's all I'm looking for. So you see, in the parent company, they said debit investment 100,000, credit bank 100,000. That is in the book of the parent company. Now, in the book of the subsidiary, they said debit bank and credit share capital. So you can see that the entry that the parent company did in their books and the entry that the subsidiary did in their book, they are different, right? There's a common item. They all have bank. So bank will cancel each other. Credit bank and debit bank, they cancel each other. Right? Now, the parent company has got debit investment and the subsidiary company has got credit share capital. But because this is a transaction between a parent company and a subsidiary, we don't want it. Remember, we don't trust any transaction between a holding company and their subsidiary. So we cancel it. We reverse that entry. So when we reverse that entry, it becomes what? Credit investment in S of 100,000 and debit share capital. We have cancelled that entry that S and that the subsidiary and the holding company did. And this is what gives us what? The pro forma journal entry. Do you understand? So that pro forma journal entry that you always see to be debit share capital, credit investment, this is the reason why they do that. They said, so what did the holding company do in their own books? They said, okay, debit investment, credit bank. They said, okay, for the subsidiary, what entry did they pass in their own individual books? They said, okay, debit bank, credit share capital. Then once we know what the parent did, and once we know what the subsidiary did, we reverse that transaction. We turn them upside. So whatever is a debit becomes a credit. Whatever is a credit becomes a debit. And we have prepared pro forma journal entry. You see how easy it is. So for every pro forma journal entry or for every elimination journal entry, this is the logic behind it. We are trying to eliminate whatever transaction that existed between the parent company and the subsidiary. Does that make sense? Let's take another example. Write in your paper. Let's say there is a parent company. This parent company sold to a subsidiary, right? When I sell to a subsidiary as a holding company, what journal entry will I pass? I will say debit accounts receivable. Let's say 50,000. And credit what? Sales or revenue of 50,000. This is a parent company has made a sale to what? To a subsidiary. In the subsidiary's own books, what journal entry would they pass as a result of this sale? Right? The subsidiary will say what? What would they say? So the parent company said debit accounts receivable, credit sales. The subsidiary will make what journal? As it receives the sales from the parent company, what would they do? What journal entry would they pass? Anybody? Just give me one side, either the debit or the credit. For the subsidiary that the parent sold to, what journal entry would they pass as they receive the goods from the parent company?
Gordon?
Yes.
Victor said purchases, debit, and accounts payable credit.
Okay. All right. Good. Good. Victor, excellent. So you see, the parent company said debit accounts receivable. I'm going to be receiving my money, right? Because I sold it on a credit and credit sales. The subsidiary, on the other hand, will say, okay, I've received some goods. Goods have been sold to me. Debit inventory or stock or purchases, 50,000, and credit what? Credit accounts payable. Because I need to pay them at a later stage, right? Good. So you can see that there's accounts payable in the subsidiary and there's accounts receivable in the parent. What does consolidation journal entry wants us to do? We don't trust any transaction between you two. So what do? We cancel it. We cancel it. So the pro forma journal entry becomes credit accounts receivable and debit accounts payable. That is the pro forma journal entry. So every pro forma, and you're going to get lots, hundreds, or every question is going to be a pro forma journal entry. So if you want to get 100% of pro forma journal entries, all you need to do is that, what did the parent company do in their books? What entry did they pass? You pass that entry. Then you say to yourself, what entry did the subsidiary pass in their own books? You also write it down. Then you reverse the transaction. Whatever is a debit becomes a credit. Whatever is a credit becomes a debit, and you are done. Does that make sense? So that is the essence. That is this whole thing of pro forma consolidation entry. That is the principle behind it. Look at what the parent company did. Pass that in entry, like I said, like a rough work or whatever. Look at what the subsidiary would have done. Right? Reverse the entries. That is your pro forma journal entry. That's your pro forma journal entry. So as we go along, we start doing questions. This is the principle we're going to apply for every single question in consolidation. We're going to pass the journal entry that the parent company did. Then we're going to pass the journal entry that the parent company did. And we're going to pass the corresponding journal entry that the subsidiary did. And we're going to reverse them. We're going to cancel them. We're going to make the debit to be a credit, and we're going to make the credit to be a debit, and we are done. And we are done. We will do the same for if it's a wholly owned subsidiary. It makes and if it's a partially owned subsidiary. That's what we're going to do. Right. So remember, yeah. So in this question, for example, let's do a question. The following example will illustrate the elimination of investment in the parent group. Okay, so we have statement of financial position as at 28th of February 20x5, right? So the statement, they have given us an extract. Excuse me. This is not a complete statement of financial position. They're giving us an extract of the statement of financial position to say that the assets, investment in B Limited at fair value. Why is it at fair value? It's at fair value because when I acquire an investment, this is what is per IFRS 9. It's a financial instrument. And financial instrument, they tell us that we must measure financial instrument at fair value. Don't worry about it. We'll do it later. In the next 3 weeks or so, or 4 weeks or so. Investment in B Limited at fair value is, according to A being the parent company, is 10,000. Then we have B doesn't have any investment, so B is dash 0. Then we have cash and cash equivalent. 10,000 in the parent company, 10,000 in the subsidiary company. So total of my cash is 20,000 for parent company, 10,000 for subsidiary company. Then we have equity and liabilities. For equity and liability, we have share capital. So ordinary shares. So the parent company has got 20,000 ordinary shares, and the subsidiary has got 10,000 ordinary shares. So this is all we have, a simple balance sheet or a statement of financial position. The question says, draft the consolidated statement of financial position. You underline the word draft. You underline the word consolidated because it's about groups. Statement of financial position for the A Limited group at 28 February 20x5. Assume that A Limited acquires its interest on that date. So in this case, the parent company acquired B on the 28th of February 20x5, and they say we must prepare the consolidated financial statement on that same date. B Limited was incorporated in February 20x5. So the question says that as soon as the subsidiary or B Limited was incorporated, that was when A Limited acquired it. So A Limited acquired B Limited on the date of incorporation. Why? Because that is why it doesn't have a lot of things. It has not acquired any investment in any other company because it's still a new company that has been incorporated. And on the day that it was incorporated, that is the same day that it was acquired by A Limited, right? And it looks like A Limited acquired all the shares in B Limited. So A Limited has got what? 100% shareholding. 100% shareholding. It's got 100% shareholding. Okay. All right. How do I know that A Limited acquired 100% of the shares or acquired all the shares of B Limited? Because if you look at the balance sheet where it says investment in B Limited, it's got what? 10,000. And the shares of B Limited is also what? 10,000. That means A Limited acquired all the shares of B Limited. So it's got what? 100% ownership control. Bear that in mind. There will be questions whereby you see that it's a partially owned. In other words, A doesn't have 100% ownership. A maybe has 80% ownership. So in that case, the investment in B will be 8,000, and then share capital of B will be 10,000. To tell you that what A Limited just has 80% shareholding or 80% control of B Limited. Does that make sense so far? Does what we have done so far make sense? Does the pro forma journal entry that exercise we did, does it make sense? Do you understand it now? What they are doing by these pro forma journal entries? Even though UNISA doesn't tell the process of getting that this is the principle behind it. That's the principle. Okay, so we've got investment in B Limited 10,000. We've got cash and cash equivalent 10,000. We've got share capital in A of 20,000. Share capital in B of 20,000. We've been asked to draft the consolidated statement of financial position for A Limited. So what we need to do is that we first need to do a pro forma consolidating journal entry, right? A pro forma consolidating journal entry. All right. So in this case, you say to yourself, okay, A acquired B, right? So what will A have passed in their books? A will say debit investment in B of 10,000, credit what? Credit bank of 10,000. Good. That is A passing a journal entry for the acquisition of shares in B. Then B will also say what? Oh, I've issued shares. Therefore, credit share capital of 10,000 to they issue the shares to A. Then debit bank, because I've got money, of 10,000. Bank and bank will cancel. So now we are left with debit investment in B of 10,000. That is in the books of A, we are left with debit investment in B of 10,000. And in the books of B, we are left with what? Credit share capital of 10,000. This transaction we don't want because it's a transaction between a parent company and a subsidiary. So we reverse it. We cancel it. So we say debit share capital of 10,000 and credit investment in B of 10,000. By passing this pro forma journal entry, you have cancelled that share transaction. You've cancelled it. And that is the main reason or the purpose of pro forma journal entries. You are cancelling it. Good. So if you go to your balance sheet, you see that if you go to your you say the journal entry is what? Debit share capital. So remember, the first thing you do when consolidated financial statements what is you join the balance sheet of A and the balance sheet of B together. So let's join the balance sheet of A and B together. If you look at the balance sheet of A and B, we have what? Cash and cash equivalent, 10,000 plus 10,000, we have 20,000. By share capital, we had what? Share capital of 20,000 plus 10,000, giving us 30,000 minus the debit of 10,000, giving us share capital of 20,000. You get it? So the first thing we do in consolidation is that we bring the balance sheet of A and B together. We join them together. So we say investment in B Limited 10,000 plus the investment in B 0. Then cash and cash equivalent, we say 10,000. Then share capital, we say 20,000 of A plus 10,000 of B. So after we've joined them on a line by line basis, we practically add them together. We add the balance sheet and the income statement and statement of change equity of A and B together. Then based on the pro forma journal entry that we passed, we make adjustment. We make adjustments. So from our pro forma, so when we added the balance sheet together, we got investment in B 10,000, cash and cash equivalent 20,000, 10 plus 10. Share capital, we've got 30,000, right? 20 plus 10. Now we go and look at the pro forma journal entry. The pro forma journal entry says debit share capital of 10,000, credit investment of 10,000. So if I go to my share capital, already I'm sitting on 30,000. If I debit it by 10,000, I have what? 20,000, right? That is why my share capital is 20,000. My cash and cash equivalent is 10 plus 10. There was no journal entry to affect cash. So cash remains what? 10,000. Let's look at investment. Investment was sitting at 10,000. Then we credited it by another 10,000 to be now is what? Is zero. That is why we don't have any investment in our consolidated balance sheet. Do you understand this? So the process is that when you are preparing consolidated financial statements, join the balance sheet of A and B together. Join the income statement of A and B together. Join the statement of change in equity of A and B together. Then, based on the pro forma journal entries, make the necessary adjustment. So in this case, when we joined the A and B together, we got investment of 10,000. We got cash and cash equivalent of 20,000, 10 plus 10. We got share capital of 30,000, 20 plus 10. Then we go to our pro forma journal entry. We said debit share capital, so we go and debit share capital. So the 30,000 minus 10,000, now it becomes 20,000. That is why our consolidated financial statement share capital is what? 20,000. Now let's go to cash and cash equivalent. We added 10,000 plus 10,000. But if we look at our pro forma, there was no pro forma journal entry which involved cash. So cash was not affected in any way. So cash remains what? 10 plus 10, 20,000. Now if you go to investment, investment was 10,000 in A and 0 in B. So total investment was 10,000. In our pro forma, we said credit investment of 10,000. So 10,000 debit from A less or plus a credit of 10,000.
Gordon?
Yes, 0.
Gordon?
Yes.
There's a question from Victor.
Victor, please ask me.
If there were multiple subsidiaries, would the consolidated statement work the same?
Yes, it will work the same. You add the balance sheet of A and B and C, and you add all the subsidiaries together. It will be the same principle. No, even if they are 100, it's the same principle. The same principle. It will not change. It's the same principle. So this is the principle that we're going to be going on. I mean, from now until honest level or whatever, is the same procedure. It's the same principle. It will never change. It will never change. We will keep adding little bits and here, but the principle is the same. What did P do? What did S do? Reverse it. Add them together. What did P do? What did S do? Cancel them. It's the same thing. Okay, all right. So if there's no other question, then I think we will call it a week. And I'll meet you again next week as we carry on dissecting complex groups and also carry on with other aspects in 2601. We will look at IAS 37 provisions. We'll look at financial instruments. We'll look at FAC 16, a new leasing standard. We'll look at FAC 15, the revenue standard, and so on, which is very, very interesting. But guys, just keep on working. The thing with accounting is that just keep on working, keep on practicing. It's all about practice, just to get. Now, when you come for lectures and you understand the principle, you go back. You don't wait until 3 weeks. No, until you have to submit an assignment. You don't do that. You go and you start practicing. You start practicing, and when you practice and you get stuck somewhere, you come to class and you ask the questions. You ask the questions, because we're going to be doing consolidation. So rather start practicing now, so that when we start doing the question, you'll be able to ask the relevant questions. Same applies to FAC2601, and you'll be able to ask the relevant questions. Okay, all right.